everybody, welcome to another one of my investing videos. My name is Mark, and in this video I am going to give you my top 3 reasons why I think stock options are the safer bet compared to if you were to buy stock. So let's go ahead and take a look at what happened. Now today is November 21st, 2018. The stock market, it opens in 4 hours and 4.5 hours. Yesterday, Twitter had a bad day. The whole stock market had a bad day. And let's take a look at what happened to Twitter, okay? And let's look at the chart. And let's bring up a 2-day chart here. And so, not a good day for Twitter, right? This is the 2-day chart. This is every 15 minutes. So, if we were to draw a little line, it was up to $33, and over the last 2 days, it dropped all the way down to $31. And this would have been yesterday. It was actually really down, and then it recovered a little bit, but it still dropped pretty good from 32 down to the where you see it close yesterday, and at about $31. Closing price right there, $31.06. So not a good day for Twitter. It's about a 2% loss. And so if I would have owned 100 shares of Twitter, I would have lost close to $200. But my account, as you can see, barely budged. I think I lost yesterday a total of $13, and this is pre-market here. And I think Twitter might have a little bit of a bounce. But let's take a look at what I have here. So this here is my call option. It's a $30 call on Twitter. Expires in January 17th of 2020. I spent $777 for that call. And my put option is a $32 put. And this one I bought for $760, I think. $765 maybe. And it expired. It's a $32 put on Twitter. Expires in 2 years, January of 2021. So these are both leaps. My call is a 1-year leap. My put is a 2-year leap. Okay. Now let's take a look at how much money I actually spent for those puppy dogs. So it was on September the 10th that I bought the call, and there it is right there. I spent $777.71. There's my put right here. That would have been on October the 26th, and I spent $767 for a $32 put. Now, if I wanted to, I could have bought 100 shares of the stock. I could have bought 100 shares of Twitter, and at $30 a share, it would have cost me $3,000. And the put option right here, a $32 put, if I wanted to, I could have shorted Twitter at $32 a share, and I would have had to risk $3,200. Okay, so right there is the first reason why stock options are the safer bet, because when you buy a call or you buy a put option, calls and puts are dirt cheap compared to the money that you have to spend to buy 100 shares of Twitter at $30 a share, which would be $3,000. Or if you wanted to short Twitter at $32 a share, that would have been $3,200. So you tell me, would you rather risk losing $3,000, or would you rather spend $777? Would you rather risk $3,200, or would you rather risk $767? So when days like yesterday happen and the stock market takes a haircut and it goes down, yeah, you're going to lose a little bit of money, but actually in my case I didn't lose hardly anything, because I own a put and I own a call. That's known as a strangle. That's a different kind of option strategy. But even if I would have just had the call, I would have lost a little bit of money, but I would not have lost a lot of money, because I'm risking so much less money than if I were to buy 100 shares of the stock or short sell 100 shares of the stock. So that's reason number 1 why stock options are the safer bet, because you are risking way less money buying a call and buying a put than you are if you were to actually buy the stock or short sell the stock. So there's reason number 1, way less money that you're risking. Now, reason number 2, again, going back to my transactions, going back to when I bought the call, when I got the party started, I have been selling calls every week. right? So I'm not just buying a call and sitting around twiddling my thumbs hoping that Twitter goes up or down and then I could hopefully sell it at a profit, because I don't have a crystal ball. This stock market's so unpredictable. I have no freaking idea of a clue what the heck is going to happen. So what do? I buy a call and then I sell calls. And so on September the 10th, I bought a call, right? That's when I bought the $30 call, spent $777, and then I started selling a call. So on September the 10th, I sold a $30.50 call, collected $50.29. A few days later, bought it back for $3, $47 profit. Then immediately sold another $30.50 call, made $48, let it expire. Again, a few days later, sold a $28 call, bought it back for $1, sold a $34 call, bought it back for $1, sold a $40 call week after week, selling calls and selling calls, until finally Twitter makes a big move in the upwards direction. And when the Twitter made a big move in the upwards direction, I buy a put option, and then guess what I start doing? I start selling calls again, and then I sell a call, and then I sell a call, and looky here, I start selling puts. So now I'm selling calls and I'm selling puts. So that's the cool thing about owning a call and a put, is that you can sell both calls and puts, and you can pay them both off simultaneously. And I just recently did a video yesterday where I'm laddering my calls and puts. So here, this put option that I sold, this expires November 23rd. That's this coming Friday. That's in 2 days from now, okay? And that thing is a $29 put. So if Twitter goes down to $29 or lower, I roll it down. And guess what's going to happen? Let me go back to my account. Guess what's going to happen to this $32 put? It's going to go up to probably close to $1,000, just like my call. And that's the cool thing about these strangles, is that when you buy a call and you buy a put, you can't lose on both ends. If it goes up, then yeah, you're going to lose on the put, but you're going to win on the call. If it goes down, yeah, you're going to lose on the call, but you're going to win on the put. And if you're selling the weekly calls and the weekly puts, then when Twitter goes up or down, you can roll down the call, you can roll up the calls, you can roll down the puts, like I'm going to do if Twitter does want to drop below $29. And this is how easy it is to roll up or down options. Okay, if I wanted to yesterday, I could have, if I wanted to. Here's my put option that expires here in a couple days. Out of the money, view the chain, and here's my put option. Bid is $6. There it is right there. The bid is 6. The ask is 8. If I wanted to, I could click on it right there. Click the buy button like this. Click the buy to close like that. Put in one contract and click the review order, and it's going to cost me a whopping $8. So if when I roll it down, I would buy to close that, and then that hopefully that order gets filled, and then I immediately go to a longer expiration, and I could go out 2 weeks, which would continue my ladder, because on this week right here I have my call option, right? So I can go out to this week, and all I have to do is find a put option that pays more than $8, and that's called rolling down. And look at this, okay? I can go all the way down to $25. I mean, how about that? So I buy to close that $29 for $8, and then I sell to open a $25, and I get $14, right? The bid is 12, the ask is 16, so I probably get $14, and that is $4 lower. That's $400 extra dollars in intrinsic value that I get on my $32 put option. So rolling down is exactly what I do. I hope Twitter does go down, because that's exactly what I'm going to do, and I'm going to make a whole boatload of money, way more money than I will even think about losing on the call. And I can also continue to sell calls. And actually, if I look at the call real quick here, let's look at what the calls pay, and let's go out of the money like this. And if I wanted to sell another $35 call, I wouldn't get that much because Twitter's down so low, but I could sell a $34 call, and I've already collected enough premium that I could do that safely. I get $45 if I think Twitter's going to stay below $34, and actually probably will. Maybe I will pick this call option. I don't know. I'll see how I feel depending on what Twitter does when the market opens in a few hours. So we'll see what happens. So that's reason number 2 why you can look at my account and you can see it hardly budges, because reason number 1, options are dirt cheap. Reason number 2, I have been selling weekly calls and puts, which also helps to offset the cost that I spend on those. Okay, and then finally, reason number 3 is known as delta, and I'm going to show you what delta is. Okay, Delta is an option Greek. It's a number that somebody a lot smarter than me invented and it's a formula that option traders use to calculate how much a call or a put is going to go up or down in value. And so first, let's look at the delta on my $30 call. Click on January, and here's the $30 call right there, and that's delta right there. And so if we go out to delta, the delta is 65. So what does that mean? That means that if Twitter goes up $1, my call option will go up $65. If delta goes down $1, I will lose $65. Now, if I own 100 shares of a stock, if Twitter goes down $1, I will lose $100. Why is that? Because stocks don't have a delta, okay? And so that delta acts kind of as a force field. And finally, you can only lose the money that you spend on a call. Now, if I were to buy 100 shares of Twitter at $30 a share, and Twitter goes bankrupt or it goes to $5 a share, I'm going to lose a whole boatload of money. If I'll lose $3,000, or if it goes to $5 a share, I'll lose $2,500. And I don't think Twitter's going to do that, but it could. Maybe there's a 1 in a million chance. But with a call option, if I spend $777 on a call, on a $30 call, and Twitter goes down to zero, I lose $777. I don't lose $3,000. And the same with a put. I can only lose the money that I spend on a put. If you short sell a put and Twitter goes to $100 a share, then you're in deep trouble. You're going to get a margin call. I can guarantee you that, right? But you don't have to worry about that with a put. With a put, you just lose the $700. So you risk less money because of a delta, and that's it. Those are the three reasons. So reason number one, options are dirt cheap. Okay, you can spend $700 for a call, or you can spend $3,000 and buy Twitter at $30 a share. Same thing with a put. You can short sell Twitter at $32 a share, put up to risk $3,200, or you can spend a few $100s on a put. That's reason number one. Options are dirt cheap. Okay, and reason number two, you can sell calls and you can sell puts, and you make money when you do that. And you saw my transactions. You saw that every week I'm making $20 a week, $30 a week, $40 a week, whatever, and it goes up and down. And remember, I spent $777 for the call, $767 for the put. That's a total cost of about $1,500, $1,510, right? And if I only make $20 a week, there's 52 weeks in a year. There is 104 weeks. Excuse me. There are 104 weeks in 2 years. So what is 100 times 20? The answer is $2,000 on my $1,500 investment, and that's if I only make that's if I only make $20 a week. And that's if my call and my put goes to zero, which they're not going to. And as I close out this video, let me point out one final thing. Okay, my call is a $30 call. Okay, that's a contract to buy Twitter at $30 a share. My put option is a $32 put option. That's a contract to sell Twitter at $32 a share. Now, what does that mean? Well, if in a year from now or 2 years from now Twitter goes to $30 a share, then my call option will be worth $0 in intrinsic value, but my put option will be worth $200, right? Because 32 minus $32 a share is a $2 share profit. Put option is a right to sell Twitter at, put option is a contract to sell 100 shares of that stock, so $2 profit. And likewise, if the price of Twitter goes to $32 a share, then fine. My put option is worth $0 in intrinsic value, but my $30 call is worth $200. So actually, I can't even lose $1,500. I can lose $1,300 because of that $2 cushion. So things are looking really good for me. And finally, the third reason is the delta. Okay, when the stock goes down, you don't lose $100 if it goes down $1 like you would on a share. The delta acts kind of as a force field, and you have a maximum loss when you buy calls and puts. You can only lose $700 whatever dollars that you spend. You can't lose $3,000 if it goes to zero. So, three very, very good reasons why stock options are the safer bet. And again, yesterday was a bad day for Twitter. It was a bad day for the stock market, but for me, it was kind of a ho-hum day. You know, big deal. I lost $13 or $10, and while the rest of the world is losing a lot more than what I would have lost, than what I would have lost had I bought the stock. So kind of a ho-hum day. And eventually, over the long run, my premiums as I sell calls, weekly calls and puts will catch up. It will pay for the cost of calls and the puts that I buy, and I'm going to make a little bit of money. So thank you for watching this video. I hope you enjoyed it. As always, if you have any questions or comments, feel free to leave a comment in the comment section. And that's it for this video, and hope to see you in the next video. Have a good day. Thank you.